we're gonna, yeah, we might ruffle some feathers putting it nicely. I think would be a nice way to put it, and in part because we're talking about price controls, inflation, like all the things that are making the headlines right now, and I think we come to a slightly different conclusion than certainly those in our camp in terms of the impact of price. We don't even come to a different conclusion than them. We just actually come to a conclusion understanding what price controls would actually do to inflation in a way that I haven't seen anyone express yet. So, and it's just going to be fun. It's going to be a lot of fun. So we're going to build a base for, what inflation is from a dynamic perspective and a macroeconomic perspective. We're going to build that base out, explain the interactions that take place and whatnot. And then we're ultimately going to show some simulations that you put together that, really just explain what would happen if, at least as it's being explained now by, Kamala Harris and her team, if you were to put some sort of price cap on, like some sort of cap on markups at the height of inflation, what would have happened? What would have that looked like? So that's what we're going to be jumping into tonight. And in classic, stay till the end engagement baiting, the results really are shocking. I mean, it's really, really cool. Ty put a ton of work in this week when we were kind of discussing the implications, and he's ran some great stuff, some great simulations. So, you really are, everyone, you're in for a treat tonight, and we're going to cover a lot. Just some quick housekeeping stuff. TR, welcome, man. Thanks for jumping in the chat. Ozzy Oz, how's it going? And if you're in chat, say hi. And I think we can just kind of get on the way. Ty, how was your week been, man? I guess, how's it going?
Well, it went well. I kind of worked all week on a report about, price caps on firm markups, profit markup. So that was rather interesting. I got to employ my national model and kind of discover some emergent behaviors, and of course we're going to talk about it. Other than that, just doing my normal things. Some of you might know I'm a day trader in the morning, so that is a feature of my life in the morning. And some of you might know me as some random research guy that writes economic blogs on his Patreon. So all that stuff
nice
happened in my week.
Nice. All right. Some of the... Usually I do my call to action to like, subscribe, do it, like, get subscribed, like that sort of stuff. But I really mean it this time that Ty and I have been working on some stuff, and the vision is really coming into its own here. And we're going to have some really cool stuff to show. I mean, it's a simulation stuff that you've seen, and building up the Minsky now macro or now Ravel models and the macro models is intriguing to you. Like, we're just a couple weeks away from having some spectacular stuff to show, and they will be in this live stream. And I mean, actually tonight is a bit of a tease of some of the things that we're building out, what we're going to ultimately be capable of. So get subscribed, notification bell on that whole thing. If you're on X, follow us there. I believe these are we should be dual streaming on X as well, so you can watch this there. Get subscribed. The other thing too, and actually Ty just mentioned this as well, he did put together an incredible blog article that is going to be posted for free over on AppliedMMT.com. So look, we have our incredible tools that we build for traders, investors, that sort of thing, the deep learning models and everything. Yeah, we have that aspect of it, but there is stuff that we do like to put on there that is just for everyone to go ahead and take in. And if you're not signed up, just put your email in there, and you'll get that article when it drops, and it'll kind of explain everything in more detail if you want to go through a little bit more slowly everything that we're going to discuss tonight. So there's my call to action. Get signed up there for free and get on the mailing list. All right, Ty. I think question number one is I think what we need to do is really just kind of get our heads around. Actually, let me actually start here. I'm gonna change subjects just to also put this in perspective. There's a lot going on in the world of inflation right now, just in terms of in terms of the headlines as it relates to the broader macroeconomic picture, as it relates to politics and where we're at in the policy kind of cycle for the current election cycle. And of course, the big thing that happened earlier this week, or I'm sorry, actually at the end of last week, was the Jackson Hole, where Powell came out and said, "Yep, we've seen what we want to see with inflation, with employment. It's probably time to go ahead and start cutting interest rates." And of course, inflation is back in the news, and the mainstream still thinks that it was the rate hikes that killed inflation or brought inflation down. And one of the things we're going to argue for tonight, that inflation was always going to come down. We can simulate that it was always going to come down, and that inflation dropping through 2023 into 2024 was in part, I'll tease for the setup later, in part because of the very price hikes that currently policymakers want to somehow get rid of, right? The markups and stuff they somehow want to get rid of. So that is one of the things that we're going to be arguing. And ultimately, I don't actually think that if you were to get cuts in, that cuts would in any way stimulate inflation. If anything, it'll just continue to actually help inflation come down. But my argument too is that we will actually end up seeing inflation pop higher here in the not too distant future, and that cuts will be relatively short-lived if they're really ever to make anything more than, say, 25 basis points. So just to set this up, connect this with markets right out of the gate, we did have Jackson Hole. It looks like undoubtedly we'll get at least 25 basis points in September. But I think that's going to be a relatively short-lived thing when it's all said and done. And then on the other front, of course, we have all the headlines that came out with Kamala Harris talking about the implementing the price hikes to cap or to try and affect inflation, and that has been the big headline, and I think we need to understand that. So, Ty, I guess let's do this. Let's understand help me just understand from a dynamic standpoint, from a broader system dynamic standpoint. I even have it's loaded if it helps, the AppliedMMT model, if you want to go over that, or if you just kind of want to chat through just the basics of inflation as it relates to the broader macroeconomy and kind of from a theoretical perspective.
Yeah, no problem. So one way you can look at inflation is you start from a theory of a price level. And when I say price level, we're going to look at the economy in a macro sense. That would be, all products aggregated together. You can start at price level of 1, let's say. Inflation is pretty simple. It's a change in that price level. But what are the underlying components of inflation? Well, you've got a couple components in an aggregated version of the economy. One is your wages. When you look at the economy in totality, wages actually include all your input costs. So one sector, is charging another sector for inputs, et cetera, et cetera, et cetera. You could roll that in aggregate all up into wage costs. So you got wages driving your rate of change in inflation. And your other aspect is what's big in the news right now is your firm markups. Okay. And then the third factor is labor productivity. If you chart all those together, kind of makes something like a sectoral balance of inflation, and you get inflation. And there's a nice little graph right there. So that's kind of the broad way I look at macroeconomic inflation.
And if I'm not mistaken, so this is, and this is ultimately what we put into our Minsky dynamic models, and this is the Koleski inflation equation, correct? the basis of it, right? The idea of
the basis of it.
The three components, which if you haven't watched it yet, Steve Keen earlier this week, and I'll pull it up right here, and this really kind of got me thinking too about this live stream as well, why the Fed fails at inflation. Again, this was earlier this week, and he goes over that component of it in a ton of detail and shows you how he kind of brings it all up and how you can get some of the data that we're about to show, like why it's gonna actually play out. So at the end of this live stream, jump on over and watch this video. I'll try to remember to link it in the description below when we're all done. But a very valuable video for understanding, what you just summarized in 60 seconds. Steve gives 20 minutes to. The essence of that, though, well, go ahead, keep going, and eventually, what we're going to run into is what's on the screen here, which is effectively the markup component of inflation. But I guess pick up from inflation. Three things can contribute to inflation at any given time. It can be markups, it can be wages, and it can be productivity, and those are the three things at play. So I guess kind of take it from there, and maybe we can piece this together and start to build out the argument into how could we simulate this and what the impacts would be.
Right. So you have to acknowledge that, the information from markups, the information from increasing wages, it's not instantaneous. So there's going to be a lag when you look at these dynamics. So if you picture wages popping up, you're not going to see that immediately in the inflation numbers. There's going to be some defined lag. In my current national model, as it's kind of arbitrary and it's just a kind of catch-all generalized capitalistic model, I selected around a year where these lags come into play. So when you're thinking about policies like a price markup, you have to kind of take into consideration if you're activating those policies because of inflation numbers versus markup numbers, you're going to have some negative dynamics show up, as we don't really. So you can't go on Fred and say what's the markup, aggregate markup value in the economy for profits and firms. That doesn't exist right now. It could. There could be some sort of collection of data. That's one of the problematic. So the mainstream is really driven on controlling inflation through wages, because we aggregate all that data and we can see it. We don't have big lags on it, and it's an effective way if you wanted to control demand through policies, which central banks try to do through interest rate adjustments, which obviously Doug always explains can be kind of counterproductive in a lot of situations. We can do that, whereas with profits, we can't, because we're not actually tracking the data. But I can also argue that profits and wages are interchangeable. They're part of that same channel. If profits go higher, ultimately down the road, wages will go higher. If profits go lower, wages are going to go lower. So it's two sides of the same coin, essentially.
Yep. So good setup here. What I have up on the screen right now, too, is, and again, this is kind of taken from Steve Keen's video earlier this week and constructed that data. It's just showing the markup, just the markup laid over. So the markup is in blue. And again, we get the markup by adding change in production with change in change in production with change in inflation. I think that's what I have, and then minus average hourly earnings. That's going to get us the markup component of inflation. Suffice to say, the blue line is the markup, the price markup, and then the red line is going to be inflation. And the whole point here is that it's very clear that at least, it's hard to say any one component caused it because it's all part of one system, one complete system here. But without a doubt, there were major markups that took place that certainly preceded inflation, but they happen for a very specific reason, right? And they happen because profits were absolutely necessary to ascertain at that point, especially because the underlying shock that happened when COVID hit was a massive shock to productivity. We had a complete drop in productivity because they essentially legislated unemployment to 25% and shut the world down, right? And in order to bring productivity, in order for the system in aggregate to bring productivity back online, you need an expansion of productivity. So you need productivity to come back online. You need an expansion of investment. And the way you get investment to start to expand is increasing profits, because that then increases further investment, and that gets you up that classic Minsky curve. And our argument is, and I'll jump to the simulations in just a second, but our argument is going to be, look, it is a intertwined system, and just like the classic example of messing with like an ecology of various predators and prey, right? We have a big field behind us, and if you were to, we know that there are mice in there and there are snakes in this field, and if you were to take away the mice, and all of a sudden the snakes don't have any food to eat, they're going to come into your house and see what they can find. So if you remove, if the wife is like, hey Doug, go kill all the mice in the field, I hate the mice, I don't want to see them, not that they ever come to our house, but they stay out there because there's a nice dynamic system that is taking care of the life that's out there. And if you take out one of those things, you're going to get an influx of maybe something you hate a lot more, right? So you kill the mice, and then all of a sudden you have snakes coming out of the field, right? So let them all just be happy in the field. Don't disrupt the system. And if you disrupt the system, you're going to have unforeseen consequences. And the unforeseen consequences are going to absolutely be there because we know the mainstream doesn't have the slightest clue about how dynamics work, and they're modeling the entirety of the macroeconomy with some hope for equilibrium that's never going to be obtained. So setting that up, go ahead, Ty.
I want everybody to pay attention to what Doug has done there and what he's identified with the markup equation, and look at that huge spike that precedes the actual inflation and is post lockdown period. Now, when I was running my simulations during the week, trying to write, basically before we put out a blog, I wanted to write an internal report that can be shared kind of between Doug and I, just to make sure we're on the same page. And so I wasn't working in conjunction with him as he was developing this equation. And I just want you guys to remember that spike, because we'll be looking at my simulation, and it's going to show something very telling.
Yep, perfect.
In it, so it's pretty interesting. I wanted to point that out. Doug, I don't know if you're ready to bring up.
Let's do it. Let's start just so we get everything kind of in a line here. Let's go ahead and start with chart number 1, and then these will all be scaled the same. So we jump that the time frame and everything will be the same. So we've recreated in our Microsoft Flight Simulator, we've recreated the lineup to COVID early 2020, and here's what plays out. Go ahead, Ty.
Yeah, so the first step in the model was we needed a control. We needed, can the model simulate COVID? And so it's a system dynamic model. Its behaviors are going to be endogenous. So if I introduce a shock, and it doesn't give me the results that I expect or saw in the real world, well, then I'm in trouble with my model. However, I was quite lucky, or maybe it was some skill over 2 years of building this model. What I did was I introduced a shock, and the way I did it to simulate lockdowns is I just simply reduced the capital utilization rate of capital. So when I say that, I've reduced the use of machines, factories, anything that contributes.
Okay, and that's our way of saying the government's imposing this shutdown sort of thing, and that just means we're putting a stop to production that way. Okay.
Yes, and then so the other factor I introduced, because that was an extraordinary situation, we've never really done that before. We basically forced a recession upon ourselves, right? It's not an endogenous. We shocked ourselves into inflation.
Yep.
So I also reduced productivity during that time a little bit. And so between the green and red lines is the period of these, hypothetical lockdowns. And we saw what we saw in the real world. If inflation dropped, I started the shock during kind of the peak of a business cycle, because I feel like that's kind of where we were in 2019. We're definitely getting to a top.
Yep.
So that's where I chose to do it. And so that's what happened. And then at the red line, I removed the shock, and it simulates that we're all going back to work. And then inflation takes off over a period of time, the following year and a half, which we saw, and then it endogenously drops afterwards. And just to keep in mind, I always, when I do these tests, and what I really like about MMT is, the whole ZERP policy. So I kept the policy rate at 0. Now, that's not to say that market rates didn't go up, because inflation's going up. Banks are putting out capital. They so the market rates went up during this endogenously, but I kept the policy rate at 0.
Yep.
And inflation still came back down, which is kind of another part of the story that Doug was mentioning earlier.
Yeah.
This is an endogenous, all inflation will be transitory in developed nations. It's going to go along with the business cycle. So that was the first step in kind of, exploring what price markups we're doing. Okay, well, we got to get a shock going and just get a baseline going. And that's what I did first.
Yep. So we have inflation. And just for those of you at home that are like, wait, this doesn't perfectly add up to, like this is not perfectly aligned to the reality that we saw. The whole point isn't that, right? The whole point of a simulation is to simulate the outcome based on the various equations that we've come up with that we think describe the theory that drives markets. And it really is kind of like a flight simulator, right? You're trying to recreate a flight. It's not going to be identical to the real thing that happened, but we've exhibited the outcome, the general essence of the outcome that actually played out, which is this massive spike in inflation that was transitory, and that the very endogenous behavior of the system is what brought it back down because of the nature of the initial shock. So that's why, although Ty did a fantastic job of lining this up almost damn perfectly in terms of how it really played out, the point is we got the essence of what played out in reality in a very similar time scale to then. Now we're going to move on in just a second to then test right now. I mean, now we get to test and see what would have happened had various policies been different at this moment in time. Ty, were you going to say anything else?
Yeah, just so with my national model, it's like Doug said, we're looking at qualitative behavior. So just, we expect inflation to rise after, the pandemic lockdowns, and that's what we saw. And the initial conditions to this model are not the initial conditions to the U.S. economy, right? It's generalized. So this is just a tool anybody can explore with to kind of test to see, where different variables go after different types of exogenous shocks.
Yes, very good. Qualitative versus quantitative models. Now that would be cool if we could build this up as a quantitative model. Wow. That is called foreshadowing. That is called foreshadowing. All right, moving on to step number 2, which is looking at now the 3 components that we just talked about: wage, inflation, and markup, relative to the time that we just saw, and what plays out given the production shocks. If you want to explain this real quick.
Yeah, so we'll just kind of, in this one, I wish I had set up some slides with productivity, and maybe next week we'll kind of amend that, and I'll have some slides showing the change in the productivity, because we were discussing it earlier. But I want everybody to kind of take a look at the green line and remember Doug's graph, which the Fed graph. And there it is, the blue surge. The blue surge. Now, I wasn't really, Doug and I usually drop, at least text to each other each day, but we weren't really talking about what he was doing there. And I wasn't really telling him exactly the results I was getting. But if you look at the green line, it's exactly
That's
what we
pretty
see
crazy. That's pretty crazy.
qualitatively in the actual real world data. The markup came before inflation. In fact, as soon as we dropped the lockdowns, markups surged. Now it's a more stylized in my dynamic model, but it's essentially the same curves you're seeing. And it dropped off, much like you see in the real world data. And then you saw a pickup in the wages afterwards. And then the red line is the actual inflation itself. So really, I was happy. I saw that graph. Doug showed it to me earlier today, and
I didn't even notice this as we were prepping for the stream tonight. Yeah, it is badass. Yeah, it's fun. That's fun.
It's something I tell Doug all the time, and we might have mentioned on over the last few weeks, right? When you're building out these models and you run simulations, then you want to take what you're seeing in your simulation output and compare it to real world data to validate your underlying theory, whether it's qualitative or quantitative, right? You want to see that behavior match reality. And so I'm satisfied. I'm patting my back a little bit on that one.
This is a really
win
cool.
in the column today.
This is really cool. All right. So now the question is, let's simulate this exact same output. So we had this inflation. We showed what happened during the shock. Now we want to, and it's really important too that we've gotten to the point where we've actually validated our theory, right? So we've been able to reproduce what actually happened IRL during the COVID period. So since we've been able to validate everything, we obviously have the right theory because we're able to reproduce what actually happened. Now what we need to do is introduce what didn't happen to go ahead and play the counterfactual and see what would take place. The assumption is right. The assumption is right that if you were to somehow do a cap on markups in this system, you're going to lower inflation. I'll tease with that, but it's the consequence that you have to pay for that that we really want to look at, right? So no more further ado, let's go ahead and show this chart off, which is really kind of the shocking result to what it is that played out. So Ty, let's go ahead and run through this.
So again, you see the COVID or pandemic lockdowns between the black dotted lines. And so this time around, I introduced a policy, a markup policy for the inflation we saw, which is between the light gray dotted lines. I don't know how that translates on screen.
Yeah. So there's two sets of dotted lines, guys. We've gone over this. There's the dotted line that introduces the shock, right? The production shock for COVID. That's these first dotted lines. Now the second dotted lines that you're seeing on your screen that my mouse is jiggling between, that is where we're going to implement this market cap or this markup cap price control thing. And that's where you see the two blue and red line diverge take place. So that's where the cap is going. So go ahead, Ty.
So, I had to make some assumptions on what a policy like this would look like. The first assumption is that it would react to inflation itself, not the markups itself, because we don't really track markups. We can, and Doug demonstrated how we could, and maybe we should be talking.
Hat tip Steve Keen, by the way, for that one. So credit where credit's due. Yeah.
Maybe me, you, and Steve need to go have a meeting at the Federal Reserve just to give them some insights on what they should be tracking. But anyways, that's another story.
Yes.
So the assumption is this policy would be triggered during high bouts of inflation at some point. And so I just arbitrarily made it that once inflation hit 5.5%, oh no, this is, a spiral. It's never going to come back down. It's going to trigger it. And the second assumption is to make this politically feasible. As you can see on social media and the news, this is quite a divisive idea. It's essentially, it's striking the chord between free markets and communism, and I try to stay out of that. But I tried, as I was putting this, restriction in, I realized, okay, it can't be that much. The business community would probably not accept something like that. So I just reduced it. So if we're assuming that the markup of profits for firms in aggregate is fluctuating between, let's say, 33% over costs and 27%, and it's kind of fluctuating in that range. I reduced it around 2%, so it was fluctuating, you know, at 31 to 27%, let's say, hypothetically. And so that's what I employed there. And so then I tracked inflation between the run without the caps and the run with the caps. And the red line demonstrates that, oh, lo and behold, during that period, inflation drops a couple ticks. That's great. And on the surface, it would probably be effective in the short term. Inflation would be down a bit. What happens in dynamic modeling is we're looking for emergent behaviors. And if you look at the final line on the graph where that policy was removed because inflation dropped enough, it shoots up above the actual original trajectory, the blue line, and inflation is higher going into the future.
Yep.
That's the first insight, right? And we can say this is just a qualitative model. Okay, it doesn't mean anything. But imagine stretching that out now another 10 years. And where is inflation above the original trajectory?
Yeah, exactly.
Right?
Exactly. So, yeah. The big takeaway is you can tame inflation by... The other thing, too, we have one more slide left. And it's really the next slide that's the kicker in terms of what the real cost of putting markup caps on. And again, I know in the, you know, on some side of the political aisle, this is very, very popular. I don't even care where you're at, right? It's your own business in terms of what you think the best policy is. The point is, it will work while they're implemented. Once they're removed, it resets immediately, and probably immediately it actually increases inflation where it would have been anyway, right? And it, at least based on this model, and just so you know too, like, I mean, in system dynamic models as well, the further out you extrapolate into time, I mean, you need to understand that other variables can change. So like the point is like, oh, eventually the blue line goes back above the red line. Yeah, like the really what we're trying to see is what is the immediate effect when in this case the markup ends, that you're not actually getting anything from it in any long-term sense. And the cost for on the short run bringing inflation down is what we're going to go ahead and show on the next chart. And that really is where you're going to realize that you are actually, again, this is policy decision, right? So maybe if your thing is just, I don't like inflation and we need to stop it at any cost, okay, fine, you can do. I mean, if you're like an Austrian and you really like big government coming in and, you know, doing what they do to make sure inflation doesn't happen, you can do that, right? You can implement markups, caps on markups, and you can get that, right? But that's fine. If that's your politics, that's your politics. But here's what the cost is going to be, and we'll go ahead and bring up this next chart and show that this is what you're, because we had those three things, right? We had wages, we had production, we had inflation in terms of, and markups in terms of the components to inflation, kind of like that sectoral balance chart that MMTers that we always show. If you add to one, you take from the other. If you take from the other, you add to another. In this three-way interplay between the three components of inflation, and this is really where the rubber meets the road, and I think is by far the coolest. This is what, Ty, I know you're itching to explain this, and I'm just gonna let this simmer here, but this is why system dynamics matters, and this is what you can only learn with proper theory, with system dynamics and blending the two in ultimately what you've put together here. This is the emergent behavior that you're going to learn when you do that. So Ty, explain to me what the cost is going to be in the long run in terms of the macro economy. What pays for the lower inflation during that time frame?
So on this plot, if you look at the y-axis, it's a lot broader. We're from 0 to 30%. So if we go right to the end, and look at the two blue lines, it doesn't look like they're that far apart, but it's actually a 5% difference. And that 5% difference is the difference in wage change. So without a markup in the model, a year and a half after the policy ended, the wage rate of change in wages going up was close to about 20% there, it looks.
Yep.
I think it was 20.2%. Look at the documentation. 20.2% versus 16.1% after there were markup caps. So what I'm saying is, with markup caps, a year and a half down the road, wages were rising slower.
Yep.
Okay.
So,
They were rising 4% slower. And then if you compare that with the past chart, inflation wasn't too different, about a half a point difference. So a year and a half down the road, as a society as a whole, for like households, you were losing out.
Yep.
Because of that
Yep.
policy. Right. So that is the emergent behavior I always think about in dynamic modeling. I'm not a DSG guy where it's all just static equilibrium and everything. You just work towards that equilibrium and, finesse the equations so you reach that optimum. I don't subscribe to that. I subscribe to emergent behaviors. If you change one part of the system, you're going to change another part. You need to know what direction that part's going to go in. And like Doug was saying, I'm not completely opposed to government intervention. You just have to think beyond the short term and kind of look at some medium term variables in the system and really ask yourself, okay, did we want lower inflation during that in the United States? I think you guys peaked around 8%, Doug, was it?
Sounds
inflation?
about right. Yeah, sounds about right. Yeah.
Did you want to lower it down to, let's say, 5% and then pay the cost for wages down the road? And keep in mind, this model's simulating an answer for us, but what it's really simulating is great uncertainty in the stability of the system. So in the real world, it could be a lot more dramatic. We don't know. That's the uncertainty. Or it could have been less. That's the trade-off. We have to acknowledge those realities, that it's an interconnected system. It's not an open loop where we say, okay, price controls or profit markup controls lower inflation, end of story. No, that feeds back into wages. It's part of the same thing, and we have to look at it that way.
This is awesome, man. This is awesome. I realized too, I should, yeah, you meant to ultimately have these cross back over. I forgot about that. Take back what I said about 5 minutes ago. Probably no one even noticed it. The point is, you're when it's all said and done in real terms, the wages, the lack of wage increase that happens from the markup case doesn't offset ultimately where we're at with inflation. And like Ty was just saying, what the macroeconomy pays, how they pay for the reduced inflation during the inflation shock is with a lower relative wage, lower real wage, I guess you could say, a year and a half later. And that is ultimately what you, I mean, that's the price you pay. And again, maybe that's worth it, right? But at the end of the day, too, and if we bring this all the way back to the implication of wage hikes, the implication of price hikes and what they mean for profit and how that ties into the investment function of the macroeconomy, those profits served a very important function in bringing the entire system back online. And that's the biggest drive home point here. And why ultimately we see wages lagging is we don't end up getting the reacceleration of productive capacity to ultimately crush inflation. And when you allow productive capacity to crush inflation, you end up with bearing the fruit of that productive capacity increase into the future, right? So if you just kill inflation by capping markups, you don't solve the underlying problem, which is the productivity shock that took place. When you allow the system to play out and clear the shock, it does so where the benefit 2 years is fully realized, and you get this, you get the economic growth that we got, and you got the big boom that we got, and inflation was transitory all along, and we ended up seeing that. So again, I know a lot of people who watch this are probably like, yeah, we should have done, U.S. policy should have been something to get in the way of price gouging, but just realize that serves a very important function in the longer term outlook, and from a firm's standpoint too, in the chaos that is something like a pandemic shutdown, they don't know if they're going to exist, right? Like it is the entire thing is absolute chaos. And I know, Ty, you've back in your earlier years, you ran a small business, and to tell a small business, or to tell any business that they can't make the best decision for themselves in that moment, it's unforeseen consequences. We're seeing it. We're seeing it in terms of how the dynamics play out.
Yeah, and I think just to drive home, and Doug really mentioned it, what really drove, what we're seeing there with the blue line and the red line, and he hit it on the head, with some delays in system dynamics. Once your information goes through a stock and another stock, each stock it goes through is essentially a leg. With those legs, what's happening is the next cycle of production, there's less profits for investment and R&D. And in my model, when you invest in R&D and investment, if there's less of that, there's less productivity, right? So what were firms trying to do coming out of the lockdowns is boost productivity, boost production, recover on profits, because like Doug said, and me as a small business owner, when the time comes to collect on profits, you do that as a business owner. That is part of your survival, right? There is this, it's not about are employees more important or capitalists more important? It's just the sustainability of the system. Profits pay wages, right? Employees create profits. It's a circular cycle, right? So it's very important. And you hit it on the head. Profits drive capital investment. Profits drive research and development. Profits got us out of our imposed recession, our little micro recession we had there, right? That was part of the system readjusting. And there are ebbs and flows to a capitalist system. It's not going to be perfect. And one of the pitfalls of shutting down our entire economy was inflation a year down the road. It was something we had to go through. And it sucks. People's bills went up before their wages went up. Now we're seeing that wages are back on top over inflation, and we've gone back into a normal capitalist cycle. So there are trade-offs everywhere. And so if you introduce a new trade-off, well, now you got another trade-off down the road. You're never going to escape that, right?
Yep.
So one thing is maybe it's not just a markup policy on top of that. Maybe there's direct household spending at the same time, right, to try to balance the system. I'm just bouncing stuff out there, right?
Yeah. So let me interject then and pull up. Derek has a good question here, or at least just a point that I think he wants to make. And he's saying that he's confused because the markup cap is only going to go apply to small segments of the economy to protect people who are very cost sensitive to essential prices. So I'm going to assume he means, effectively like groceries and stuff like that. And Derek, one, maybe an endeavor that we can do down the line, I don't know if we'll do it, but is to go ahead and do a sectoral mean like building out various sectors, whether it be something like consumer goods like groceries versus product, or versus like services or products like cell phones. If you break out each sector, that maybe you could just impose a cap on a certain segment, and then you could see. But I mean, at the very least, I think what we see in this is there are knock-on effects, no matter how small or how targeted the markup cap would have been. And I mean, the other thing too that I'll at least stop there. I'll just stop there. Yeah, go ahead, Ty.
Well, and the thing, and I thought about this while I was kind of writing this up and kind of simulating it, is how do you decide which market is being greedflation? How do you really decide that? Our market has evolved where there are some sectors that are more powerful than other sectors and drive things. How do you decide as a politician what that is in the moment of a crisis? That's very difficult. And the other thing is, too, that's really problematic. If you institute this on a national level, let's face it, we have global supply chains, right? So if you start picking one sector that's going to have this markup cost, that sector actually might be very tied into a globalized system where there are no markup caps being in place, and puts them at an extreme disadvantage. And then you're looking at bankruptcies, right? And then you're looking at a collapse of a sector, which is then a collapse of the economy, and becomes very problematic and complex. So I thought about, what would it look like targeting, specific sectors? And that becomes very problematic from a political perspective and a system perspective, because we're dealing with a policy that's on a national level. Meanwhile, we're dealing with a system that is international, which my model encompasses, foreign exchange as well. So that's why I really just stuck to an overall pricing scheme that applies to the whole economy.
I like it, man. I like it. So the question is, what's next, right? What's next from here? And to bring this full circle to, by the way, Derek, appreciate the question. And to bring this full circle, what ultimately cured inflation was productivity coming back online. And that allowed what we'll just call the normal capitalist cycle to kick back in and kind of reset the system. So the big question now is, and again, that cured inflation. That's exactly why inflation is always transitory when it's from a shock, right? The way you get inflation to be permanent is you just start hiking interest rates. You change the very value of cost of money. That's how you get inflation to effectively always go up. So I think going back to the point then, when is inflation going to finally start kicking in? And I'll tell you, I really thought that at this point we would actually start to see inflation reaccelerating once again. And I think where I was wrong is I just didn't realize how successful bringing productivity back online what was ultimately going to be when you had the wave of fiscal stimulus that then kicked off this brand new business cycle. The reason that inflation continues to push lower over, let's just even say from like mid 2023 to now, so over the last year, is really just because we've seen just a massive expansion of productivity in terms of just output and growth. And it's really that factor that continues to push inflation lower. What I will say though is if markups are part of this, and and again, these are, Ty's models are qualitative, not quantitative, but we are starting to see markups tick ever so slightly higher. This is, quarterly data, and it's a little bit lagged, so we're off on the quarterly data. But we did see in Ty's model is you get the plummeting, and then you get the markups to start to take off again, which is just the normal part of the next business cycle. Wages start to push higher. We're not quite seeing wages push higher, but once that happens, once those two things happen in alignment, and again, we see, it looks like in general, we're going to see the markup portion of this happen a little bit before the wage. Once we start seeing the wage part, which could be right around the corner, that's when we want to start looking out for the next wave of inflation. And I really think in the not too distant future, that is likely what's going to happen. And if it happens sooner than later, which I think is a pretty good chance, then eventually what's gonna play out is the Fed's gonna do their one cut, and they're gonna be like, well, inflation's back, and we need to be concerned. So they might start hiking, and it's the hiking that actually embeds structurally inflation into the system. And if we get a hiking cycle to happen as inflation starts to actually tick back up, right? If the Fed ultimately says, maybe these cuts weren't what we actually needed, let's start hiking to get surprise inflation back lower, that can get us into a 1970 type of echo boom, if you will, in inflation that could last for kind of the remainder of this decade. So as of right now, I still actually think that's probably the most probabilistic outcome, given where we're at, and the fact that we continue to still, the Fed is still continuing to fight this. Okay, God, we keep seeing a booming economy, even though employment had this jump higher, which we explained why in a recent live stream, and even though inflation continues to come down, if the economy is still booming, in their mind, do they really want to cut rates substantially? And if they don't, then that means the interest income channel and everything that's allowed this boom to take place will continue on. And in my mind, early next year, I would say the Fed could easily be back at saying, okay, we need hikes again. So to bring this full circle, like I said, I think we're already seeing the signs, and we just need like the wages to really start to kick higher here. And when we see that means the next wave of inflation is imminent. So bear that in mind in terms of at least how I piece this all together, forecasting forward. I'm seeing some other questions here, so give me 1 second to pop that over. Ty, did you have anything to add to that before I bring up? I don't know if this is a question or not, but we're going to bring it up anyway. Go for it.
So yeah, I just want to add, the Fed moving interest rates, and not opposed to market, rate changes that affect other rates downstream. I'm not opposed to that. We just don't understand enough, I think, dynamically, for the Fed to be making the moves they always make. But picture it as just another shock. So we introduced the price caps shock into the model, and it gave us unintended effects. When the Fed lowers or raises, depending what's going to happen, I guess they're on the lowering
right now. That seems to be the promise. Yeah.
You introduce things downstream that you don't understand, unless, the Fed starts using my model, which I advocate. Jerome Powell, my name's Ty Keynes. I'll put it out there. If you want to get together, we can talk about system dynamics. But unless they're going to do that, they should probably really not move the rate at all. In fact, I wouldn't, if they just left it. What is it down in the States? I'm Canadian, by the way, guys. What's it down in the States, the policy rate right now?
The Fed funds rate is at 5.25, I believe.
Yeah, they could just leave it there. Don't move it down. Don't move it up.
Right? Or 550. Yeah.
Even though it's been almost 4 years since our experiment of shutting down the economy, we don't know really the 10-year horizon of what that meant. Does it mean? I think, Doug, you called it like the shadow inflation after the first one.
Yeah, the echo boom. Yeah.
Does it just mean that we're going to be in a whipsaw for the next 10 years, and that moving the interest rate is chasing something that they can't catch, right?
Yep.
That's kind of just, from a systems thinking perspective, my idea on that. Definitely not as technical as Doug would say it, but that's just, my opinion.
Just going to point out Nick Gomez's point, just in terms of food and energy. Oil execs were bragging at shareholder meetings that they could raise prices without exploration costs. So yeah, and I would say too, just going back to the larger discussion about where might inflation, head into the future. One thing that would obviously bring the inflation thing right back on board would be oil pushing higher, which it hasn't. I think there's space for it to push higher, and we might see that into 2025, but that would be That would be a biggie again if we started seeing that press higher. Ty, this has been another good live stream. Before we go, everybody, again, AppliedMMT.com. Ty has a great write up. We're going to I'm going to proofread it tonight. Make sure. Well, I don't need. I mean, it's right. We're going to spiff it up, get it up on the site for free. So put your email in there if you want to go ahead and get that when it drops. Then if you are an active trader, active investor, check out the rest of the channel. We have a ton of tools. Check out like the deep MMT tools and the fiscal flow stuff that we have. Those tools, I find them, obviously I built them for my own self, for my own investing, so I find them invaluable. But we really have been crushing it over there as well. So yeah, active trader, active investor, check that out. And if you are new here and you've made it this far, man, make sure you get subscribed. If you're watching this on X, follow me over there. Hit the thumbs up button as well on the way out. And again, you want to be subscribed. If you heard the foreshadowing halfway through this stream, we got some cool things coming, and you're not going to want to miss it. So, Ty, I have nothing else for tonight unless you do. I think we might be able to say good night and another good stream. So, anything on your end?
Yeah, no. Yeah, I think it's just in closing, just, think every action you take as a policymaker, or if you're thinking about how policies affect the economy, there's always that equal reaction on the other side of the year, the other side of the calendar, right? There's something else to think about in aggregate as a system as a whole, and that there is no, I make a decision and the problem goes away, right? That it creates another set of problems,
yes.
Right?
Yep.
And that's fine. If you want to create those problems, that's fine. Just be prepared that you have to deal with those problems as well in the future.
Right on. Well stated. Yeah, way to close it out. All right, everyone, until next time, good trading, and we will talk to you then. Bye-bye.